Every time dividends come up, I feel like we get the same two extremes in the comment section. First of all, you have, I would never sell my shares in retirement. I'd just live off the dividends and keep my shares forever. Then we have those who say, dividends don't matter at all. It's total returns that count. So who's right? Today, we're going to walk through what decades of data really say about dividend investing and, more importantly, what that means for you, whether you're in your 20s, 30s, 40s, or at or near retirement, say in your 60s or 70s. We'll look at how much of the total stock market return really comes from dividends, why reinvesting those dividends is so powerful, the role dividends play in modern markets, what smart dividend investing looks like at different ages, and how dividends interact with RMDs once you're in retirement. My goal is that by the end, you see dividends not as the magic answer, nor as a total waste of time, but rather one tool inside a total return, flexible, tax-aware plan. Hey guys, what's up? I'm Erin, and welcome back to the channel. Let's start with the really important point that most dividend debates skip. A dividend is not free money. It can certainly feel like that when the cash hits your account, but mechanically, a dividend is just a transfer from the company's balance sheet to you. When a company pays a dividend, the share price adjusts down by roughly that amount on the ex-dividend date. This isn't an opinion, this shows up in chart after chart. So if a $100 stock pays a $2 dividend, everything else being equal, the stock will open around $98 the next morning. You're not any richer because of the dividend. You now have $98 in stock and $2 in cash versus $100 in stock the day before. Economically, it's the same thing. That's why a lot of academics and firms frame dividends as forced withdrawals. From a math standpoint, withdrawals and dividends are twins. Money comes out and the portfolio drops in value. So when people say, I'll never sell shares, I'll just live off the dividends, it might feel good emotionally, but financially, there's really no difference between these two actions. And that certainly doesn't mean that dividends are useless. It just means we have to be honest about what they actually are. Let's zoom way out and look at the market as a whole. From around 1940 through 2024, dividend income has contributed roughly 1/3 of the S&P's total return on average, about 34%. Said differently, historically, if the markets returned around 10% a year, something like 3 to 4 percentage points of that came from dividends, and 6 to 7 points came from price growth. But here's the crucial part. Those statistics assume you reinvest the dividends. When researchers show charts that say X% of your return came from dividends, they're not assuming that you're taking these dividends out and using this cash. Instead, they're assuming you're plowing these dividends right back in, buying more shares, which in turn end up paying their own dividend as well. That compounding is where the magic comes from. For example, one long-term estimate shows that $100 invested in the S&P in 1926 with dividends reinvested grows to roughly 1.8 million by the end of 2025. That's about a 10.4% annual return. Without reinvesting dividends, your ending wealth would be a tiny fraction of that, depending on the rate of return you use. You'd still get price growth, but you'd miss out on the exponential effect of each dividend buying more shares. Dividends are incredibly important when reinvested, but they become far less important when taken in cash. Dividends have historically explained a large portion of total returns, but that's assuming they're reinvested, as we discussed, with total returns. Once you get to retirement, and if you start pulling your dividends and spending them rather than reinvesting them, you do change the compounding engine. Rather than buying more shares, your dividends are now buying your electric bill. So you can't point to the historical stat that dividends made up 30 to 40% of returns and assume a dividend-only strategy will give you the same outcome today. It won't, because the reinvestment is what created that growth. It's also really important to see that dividends don't play the same role today that they did in our grandparents' market. Historically, the S&P 500's dividend yield often sat in the 3 to 5% range, but since the early 1990s, yields have consistently stayed under 3%, and in recent years, the yield has hovered closer to 1.2% to 1.6%. Why? Well, there are a few reasons for this. The rise of tech and growth companies that reinvest profits rather than paying big dividends. A shift towards share buybacks as a way to return cash to shareholders. Companies retire shares instead of sending you a cash dividend. Stocks have climbed faster than dividends, so dividends make up a smaller percentage of the price. That's why yields are lower today. The result is that while historically you could have expected a reasonable dividend of 3 to 4% if you had a basket of broad-based U.S. stocks, today that dividend would be closer to 1 to 2%. So that means today, if you want a strategy where you live off dividends only, you either need a very large portfolio or you need to stretch into high-yield stocks or specialized funds, which will bring its own set of risks. We'll come back to those risks in a second, but first, let's take a moment to talk about the tax treatment of dividends. One of the arguments you'll often hear in favor of dividends is that they get more favorable tax treatment. But in reality, dividends and long-term capital gains, which is how the vast majority of portfolio draws are taxed, share the exact same favorable tax treatment, at least in the vast majority of cases. Qualified dividends and long-term capital gains are both taxed at 0%, 15%, or 20%, so on the surface, the tax treatment looks identical. But here's the nuance that really matters. While the tax rate may be the same, it's very different in terms of tax flexibility. Dividends are a forced realization. When a company pays a dividend, you owe tax that year, assuming this dividend is outside a tax-advantaged account. Whether you want this income or not, you don't get to choose the timing. With capital gains, you get an elective realization. You only pay tax on capital gains when you choose to sell the stock. This can give you far greater control on your income, and if you're in retirement, it allows you to control your tax strategy. It can affect whether or not Social Security is taxed or whether you're hit with Medicare surcharges. It becomes very powerful, and control is almost always more tax efficient. Also, it's worth keeping in mind that not all dividends qualify for favorable tax treatment. Non-qualified dividends are taxed as ordinary income, which is really common with REITs, real estate investment trusts, bond funds, many international stocks, and a lot of high-yield strategies. So the idea that dividends always get favorable tax treatment isn't true. Sometimes they do, and sometimes they don't. Dividends aren't automatically better from a tax perspective. They're one way your portfolio pays you. Long-term capital gains is another. And in many cases, capital gains offers far more opportunities for tax planning simply because you can control the timing. And let's take a moment and talk about how dividend investing fits in at different ages, because a smart strategy at 25 is very different than a smart strategy at 65. In your 20s, high growth beats high yield. In your 20s, the single biggest driver of your future wealth is growth. Growth in your income, growth of your skills, and growth in the value of your investments. Historically, the strongest long-term returns have come from areas like small cap and mid cap stocks and growth or innovation sectors, not from high yield dividend payers. Dividend-heavy portfolios are generally filled with mature and slower-growing companies, which means they simply don't have the ability to compound as fast over long time horizons. So in your 20s, the smartest way to use dividends is simple. Reinvest them automatically and treat them as bonus shares, quietly adding fuel to your compounding engine. But building your entire strategy around dividend income in your 20s is a trade-off and generally not a good one. You generally trade long-term growth for more cash flow, which you typically don't need at this stage. Over several decades, that can leave you with a much smaller portfolio than if you had prioritized growth. So your role here at this point is to simply reinvest those dividends. At this stage of life, you don't want to be maximizing income from your portfolio. You want to be maximizing growth because growth is your best friend when you have a long time horizon. In your 30s, you still want to be growth dominant with an optional quality tilt. In your 30s, a few things start to shift. Your income usually rises, your career tends to stabilize, but you still have a time horizon that stretches several decades, so you still want growth to be the primary driver of your market portfolio. At this stage of life, it can make sense to sprinkle in some dividend growth funds if that investing style appeals to you. And when I say this, I'm really focusing on strong, broadly based ETF funds that really invest in growing companies and companies with really strong balance sheets. The key phrase here is to sprinkle in. What you really want to avoid is building a primarily income portfolio 30 years before you need this income. Chasing 4 to 7% yields in niche sectors like utilities, telecom, or REITs, ending up too concentrated in slow growth or high-risk corners of the market. At 30, you don't want a portfolio that's built around income, yet you still want it to be built around growth. You can have dividends start to complement your portfolio, but you don't want it to be the main primary driver of your portfolio, because at this stage, you really need growth to be the primary driver, and your strategy should reflect that. In your 40s, you can start blending growth and stability. In your 40s, it's the first time where dividends might start to matter in a different way. Not because you're living off them yet, but rather your portfolio is larger at this point, or likely larger, so volatility feels more real. At this point, you might be 10 or 20 years from retirement, depending on your time horizon, and diversification starts to play a bigger role here. At this stage, a blend can work really well. Keep your core in total market or broad index funds, add some quality or dividend growth exposure to smooth out the ride if this investing style appeals to you, and importantly, you still want to reinvest all your dividends. You still benefit most from compounding at this stage. Chasing high yields in slower growth sectors can mean giving up too much future growth in exchange for income you're not actually spending yet. Dividends can be helpful for diversification and stability, but they are not your primary income engine yet. Your 50s to 60s, now dividends become a tool, but not the whole plan. Once retirement is, say, 0 to 15 years away, the conversation really shifts. At this point, dividends can serve practical real-life functions. They provide a natural source of cash flow. They reduce the psychological hurdles of selling shares. They can complement your RMDs and your broader withdrawal strategy. And within a total return framework, they can help reduce how often you need to sell during volatile markets. But it's also important to understand the limitations too. Broad index funds only yield around 1 to 2%, generally not 4%. High yield strategies often come with sector concentration risk and can underperform over time. And dividends are never guaranteed. They can be cut, sometimes at the exact moment that you're relying on them most. In your 50s or 60s, dividends can absolutely become part of your retirement paycheck, but they shouldn't be the only thing that drives your investment and income strategy. You still want a plan that considers your total expected return, your withdrawal rate, your tax strategy, and your true risk capacity. So I would say dividends can support that plan, but they are not an entire plan in and of themselves. Now we have retirement in your 60s or your 70s. Here, dividends are useful, but not a replacement for a withdrawal strategy in retirement. Once you're actually in retirement, the core question changes to something a bit more practical. How do I turn my portfolio into a reliable paycheck that lasts as long as I do? And this is where you hear people say, I'll just live off dividends, that way I don't have to sell any shares. And emotionally, this can make sense because it can absolutely feel different than going into your account and executing a draw. And the truth is, behavior often beats optimization for 95% of retirees. If living off dividends helps you to stay disciplined, avoid panic selling, and sleep better at night, there's real value in that. But here's the challenge. Dividends alone typically don't reach that 3.5% to 4% withdrawal rate most retirees could rely on. Yields have steadily declined over time into the 1 to 2% range, even with high yield strategies, and this alone might not be enough to stand on. They also don't easily adjust if your spending needs change, and they don't protect you from big expenses, sequence of returns risk, or inflation on their own. That's why the most successful retirees will use multiple income sources together. Dividends, bond interest, realized capital gains, planned tax-efficient sales of shares, and rebalancing between asset classes. This is also where RMDs can come into play, and for a lot of retirees, this is a misunderstood part of the income equation. So how do dividends and RMDs actually work together? If you have money in a traditional IRA or 401k, once you reach RMD age or required minimum distribution age, the IRS requires you to withdraw a certain percentage of your balance each year. And here's the part that often gets lost. Only the money that leaves the IRA or 401k counts toward your RMD. It doesn't matter if that money came from dividends, interest, selling shares, cash already sitting in the account, it doesn't count towards your RMD unless it's withdrawn from the account. So if a dividend is paid inside your IRA but stays inside your IRA, whether it gets reinvested or sits in cash, it does not count towards your RMD. Let's look at an example. Let's say your IRA generates $12,000 in dividends and interest this year. If those dividends stay inside the IRA, whether they sit in cash or are automatically reinvested, $0 count toward your RMD. If you withdraw that $12,000 to your bank account, $12,000 now counts toward your RMD. So if your required RMD is $20,000 for the year and you withdraw only $12,000 in dividends, you still need another $8,000, which typically comes from selling investments inside your IRA. Let's look at another example. Your high dividend portfolio produces $25,000 of cash inside your IRA. If the $25,000 stays in the IRA, $0 counts towards your RMD. If you withdraw all $25,000, you've satisfied your RMD, even though it may be more income than you actually needed to spend this year. So in other words, dividends only count towards your RMD if they leave your account. Any dividend that's paid out within the account, even if it stays in cash and is not reinvested, does not count towards your RMD until it leaves the account. And also, I would say dividends by themselves do not replace a thoughtful withdrawal plan. This is exactly why the historical contribution of dividends to total returns does not automatically translate into a dividend-only retirement strategy being superior. Part of the appeal of using dividends to satisfy an RMD is that mentally, it lets retirees feel like they're holding on to their shares. But here's an important reminder, you don't have to sell shares to satisfy your RMD. If you're set on maintaining your investment mix, you can do what's called an in-kind transfer. An in-kind transfer simply means you move the actual investment, shares of a stock or fund, from your IRA into a taxable account instead of selling it for cash. The value of the shares transferred counts toward your RMD, and you still remain invested the entire time. It's quick, it's allowed, and it's a great option for retirees who want to keep their investments intact and not liquidate their positions. I'm not going to go into this too deeply in this video because I do have other videos on it, but I just wanted to mention it here. A thoughtful retirement plan starts with a sustainable withdrawal strategy, static or dynamic, and then asks what mix of dividends, interest, and planned sales gives me the income I need in the most tax-efficient and comfortable way. Dividends are one helpful tool, but they're very rarely an entire plan. Let's do an example looking at dividend income versus income from a balanced portfolio. Before we look at real numbers using Vanguard's high-yield ETF VYM, let's make sure we frame this fairly. If you're taking just the dividend, two things are true. Number one, you're not selling shares, which many retirees love. Number two, you're not reinvesting, which means those dollars stop contributing to long-term growth. And that may be perfectly fine because at this stage of life, you might be prioritizing stable, predictable income rather than growth. So let's go back to the data-backed answers. Dividend investing is not a growth strategy, it's an income strategy. Stable, reliable income. And if you want to rely on a dividend-only strategy, especially in today's market, you're going to need a much larger portfolio than what an evidence-backed safe withdrawal strategy would suggest. That doesn't make dividend investing wrong, but it does mean you might have to save more, work longer, invest more aggressively to build up a portfolio large enough to sustain the spending you require. And oversaving certainly isn't as dangerous as undersaving, but it does require a trade-off. You're trading more life hours for more financial security in the future. So the fair questions become, how big does this portfolio need to be for dividend-only income, and how does that compare to a traditional withdrawal approach? VYM gives us a clean way to compare the two. A dividend strategy does offer powerful psychological benefits. You get income without selling shares, and a paycheck-like flow, and that feeling of living off the fruit without cutting down the tree. The trade-off is that the yield on these funds is going to be closer to maybe 1, 2, 3% depending on market conditions, whereas safe rates of withdrawal generally sit in the ballpark of 3, 4, or 5%. Dividend-only income produces less income per dollar saved because it restricts how you access your portfolio. Both approaches are valid, they simply solve different problems. Currently, VYM has about a 2.4% yield. To generate $35,000 a year in income, you would need a portfolio of about $1.46 million. However, if you were to follow a 4.7% withdrawal strategy, which is considered a safe rate of withdrawal with inflation adjustments, you would need a portfolio of around $745,000. You need nearly twice the portfolio to generate the same income from dividends alone. Again, not bad, just different math and different goals. But dividends still appeal to many because this strategy can offer psychological comfort, simplicity, some inflation protection, and behavioral resilience. And for many, behavior beats math, and dividends solve a real behavioral challenge. You don't have to sell shares, and for many retirees, they don't want to. But safe withdrawal research still matters. Withdrawal strategies offer higher sustainable spending, more diversification, portfolio flexibility, and the ability to adjust spending as life changes. Maybe that doesn't feel as stable emotionally, but it's far more efficient, and the data has to count for something. Maybe a more fair and realistic approach is to simply use a hybrid. The most successful retirees blend dividends, interest, flexible withdrawals, a cash buffer, and ongoing rebalancing. This approach taken together can reduce risk, increase optionality, and support both the math and the psychology of retirement. Let's take all of this and boil it down to two simple lists. 1, where dividend investing shines, and 2, where it backfires. Where dividend investing really shines, number 1, taxable accounts for some investors. For some people in the 0% or 15% qualified dividends tax brackets, dividends can be extremely tax efficient. This can be one of those places where dividends genuinely have an advantage. Number 2, behavior and simplicity. A lot of investors simply feel better seeing that income roll in. And if your dividend coming into your account keeps you invested through volatile periods, well, optimization is not the only thing. Behavior matters, and behavior can beat optimization. Number 3, quality dividend growth strategies. Dividend growth ETFs often screen for things like profitability, strong balance sheets, and sustainable payout ratios. And this can be a far better approach than simply chasing the highest yielding stocks on your own. Now, where a dividend-only plan backfires is, number 1, yield chasing. Those tempting 6 to 10% yields often come from companies or sectors under real financial stress. The exact same companies that are likely to cut their dividend. And if retirees are just constantly chasing the next highest yield, this can add more risk to their portfolio than necessary. Number 2, sector concentration. High dividend strategies often end up very heavily concentrated in just a handful of sectors, like financials, utilities, telecom, or energy. And that's fine with a slice of the portfolio, but risky if it becomes the whole pie. And finally, there's rigidity. If your entire plan is I only spend dividends, you lose flexibility. You can't easily adjust your withdrawals or make tax-efficient moves, and ironically, this rigidity can increase your risk of running out of money because you're not able to use the tools available to you. So if the answer isn't dividends only, and it's not dividends don't matter at all, what is the practical middle ground? It's a total return framework, and here's what that means. You design a portfolio based on the level of risk and return you need. You let the portfolio pay you through a mix of dividends, interest, and planned sales. You make sure your withdrawal rate is sustainable. You use smart tax planning and smart asset location to keep more of what you earn, and you treat dividends as one tool, not the entire strategy. For many retirees, a safe, sustainable withdrawal from their portfolio would be in the ballpark of 3, 4, or 5%. And here's what that might look like. Maybe 1 to 2% comes in the form of dividends and interest, and 2 to 3% comes from capital gains, rebalancing, or scheduled draws. That's a great blend. That's where you have balance, and that's the part that's often missing from a dividend-only discussion. A lot of times, dividends get presented as if they're almost magical, as if somehow following a dividend-only approach is superior to a well-thought-out withdrawal strategy, and that's simply not an accurate presentation. Dividends are not a separate universe of returns. They are simply one portion of your portfolio's total growth, and ultimately, they're just another way of taking a withdrawal. They feel different, and behaviorally, that can be helpful, but financially, they're part of the same total engine. And that's why understanding dividends in their true context matters. They're not a magic income machine, but rather part of an entire sustainable strategy. Dividends are just one way your portfolio pays you. They're not automatically safer or better, they are a preference. The real goal is cash flow that lasts your whole life, not cash flow that comes only from one corner of the market. A thoughtful retirement plan isn't dividend only or growth only. It's built to fit your life, and it's definitely not built around a company's payout structure. There isn't one perfect income strategy. There's the strategy that fits you, your life, your goals, and helps you to sleep at night. Dividends might play a large role in that, they might play a small role, or they might play no role at all. What matters is that your plan is diversified, sustainable, tax smart, and built around your behavior. Dividends aren't magic, they're not free money, they are simply one way your portfolio pays you. If they help you stick to your plan, great. If focusing on total returns is what helps you stick to your plan, great. There is no wrong approach, it's just the one that works for you. So what are your thoughts on dividend investing? I'd love to hear. Leave them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. My goal is that by the end, I don't know. You either need a very large portfolio or you need to stretch into and I would always say that dividends do not count. They count. In some form, they count. That means if you want a strategy where you live off dividends only in 2025 or 2026, I'm just going to say today, rather than bringing in a year. We got 3 weeks left of this year. So why commit to 2025 when it's going to be 2026 soon? In your 50s or 60s, dividends can absolutely become part of your retirement paycheck, but they shouldn't be your only